the oddity of the preferred stock investment. You've heard the phrase, it's not fish nor fowl. That's kind of what preferred stock is. It's kind of like a stock and it's kind of like a bond. So it really is a cross, it's a hybrid financial instrument. So the preferred stock investment is unique. A lot of times it's issued by companies that have a low credit rating. So you want to pay attention to that aspect of it. So, but you have different provisions in it. So we're talking about the provisions of this, and it is an interesting component. If you have a healthy portfolio and you want to be able to get more money with a somewhat stable base, it's not quite as stable as a solid AAA rating for a bond or a AA rating. A lot of times you issue them by companies that have lower credit ratings, except for the fact that you have priority. So let's talk about the components of this preferred stock. It's an equity security, and it's got these two characteristics. Like stocks, it represents ownership in a company, and usually it pays dividends, which is why it's called preferred. You're above all those commoners when you have preferred stock, because of the fact you're a preferred person, and you'll get dividends first almost all the time before those common people with the common stock. But like bonds, they have a fixed dividend rate, and they have a priority claim on assets in the event of liquidation, which is a big deal, especially if you're dealing with a company that has a shaky credit rating. So this is like a preference over other people as well. So you have the preference for dividends, and you also have preference in the aspect of a priority claim on assets in the event of liquidation. So you'll see this happening sometimes with smaller companies that are trying to avoid paying high bond rates. They'll issue preferred stock as well. So you'll see different aspects as the when they produce it and who is selling it in the process as well. It represents ownership of the company. Usually a preferred stock is the shareholders are entitled to dividends, not always, which is why you have to pay closer attention to the face of what's on the actually preferred stock. And they occasionally have voting rights. It's pretty rare though, but for the most part, you can have voting rights. Typically, there's a fixed dividend rate, which makes it attractive because it pays 8% annually. And a lot of times that dividend rate is higher than you're going to see certainly at any bank out there, and also probably exceeds that of the different Fed rates and Treasury rates. So it'll pay higher usually, but that's for you to pay attention to what the market is and also what the preferred stock interest rate is. So that being said, they have priority claim on assets, and the prices can fluctuate when you want to sell them. You'll see that they're going to sell the preferred stock to raise capital for a variety of purposes, expanding operations, acquisitions, repaying debt. A lot of times you issue preferred stock to liquidate debt over here to get rid of high interest rates or the obligation to repay the principal that's coming up. So preferred stock can be more attractive source of capital than bonds for companies that have poor credit ratings. So, and it typically has a lower interest rate. Preferred stock can have a lot of benefits. Its income provides a fixed dividend rate. Usually it's a reliable income stream for investors. It has an opportunity to grow like regular stock, especially if the company is expanding and are selling it for acquisition purposes. And diversification, because you may have a nice healthy portfolio of stocks, bonds, and ETFs, mutual funds, and so on. And also you have this other thing over here, preferred stock. It makes it more interesting, and overall can help balance out our portfolio in the aspects of risk. There's multiple different things on the face of preferred stock. Cumulative preferred stock is very common. In other words, we will pay you 8% annually, and here's your dates, and so on. You'll have that, but because it's stock and not a bond, the company may not have to pay you that 8%, but it's cumulative. So in other words, if the company 3 years from now goes and pays a dividend to all the shareholders, you'll get the first round, and you also get back dividends on top of that before they pay those common people, because you are that preferred person in that preferred share. So that being said, when the company starts resuming because they've admitted payments, then you sit down and you get back pay. Now you also have non-cumulative. So the company 3 years from now, may start paying dividends again. If you have non-cumulative preferred stock, you don't get that back pay. So it's like, okay, well, I really wanted it, but didn't get this year. So that being said, convertible preferred stock has nothing to do with using it to buy convertible cars or manufactured convertible cars. No, it's convertible. You get 1 share of preferred stock. Let's make up a couple numbers. It's $100 for a share of preferred stock, and the current amount of common stock is 50. If you buy that 1 share, in 3 years, you too can have 3 shares of common stock for the price of $50. That being said, we'll see what happens, because maybe that common stock is going to be up. So it might have a specified price. It might be a time limit, such as I described over here, and maybe 3. So you'll have a number of different common shares. You can convert that preferred stock into 3 shares of common stock. But 3 years from now, you don't know. The common stock may be $50 a share, or the common stock might be $25 a share, and maybe that $50 deal isn't a good deal. But maybe that $50 deal, maybe that common stock is now $75 a share, and all of a sudden now talk about a sizable increase, because you also have preferred stock. You will probably have some kind of a dividend, and on top of that, you might be able to convert it. This is one of the magics of preferred stocks, the convertibility of it. Sometimes, like almost all bonds have a callable provision. Preferred stock usually has a callable provision, not all the time, but usually. In other words, if they want to liquidate that obligation of having to pay dividends on an annual basis, they can call it back and then reissue something else, or just call it back altogether and not worry about being in the market whatsoever. So there's a callable provision. Sometimes you'll have a floating rate that's tied to different numbers out there, such as LIBOR or whatever, even maybe the Fed fund rate. Just depends what it's out there. You have a floating rate on the preferred stock paying dividends, which is very attractive in the case you have inflation happening or whatever the market is like out there, because it's keeping up with the current market. When you're evaluating preferred stock investments, consider some of the factors. The dividend yield. See what it's out there, see what it's being paid for by the share price. Also, because sometimes it's sold for a premium, sometimes for a discount on the face of it, depending on what is out there. And that also is contingent upon what the current rate is out there. So evaluate it there. Look at the credit rating. It is a big deal on this type of investment, because the credit rating can change. They can change really the aspect of what you're looking at. If you're down into, and if we're selling bonds, a C bond level, you have a junk level for bonds, and it's probably why they're not selling bonds, because nobody wants to touch them. So this might be a better investment than buying a junk bond, but it certainly is a kind of a scary thing if it's a matter of a preferred stock investment. Pay attention to the credit rating. That's a critical issue on preferred stock. The call features, the likelihood that they're going to redeem that in the future. It could be they're just issuing a preferred stock now to expand, and that might be a good thing, but watch the call features and watch the convertibility. The convertibility is often a real major factor, because of the fact you might be able to turn this from preferred stock, get your dividends on a regular basis, and boom, 3, 4, 5 years from now, whatever the date may be, you convert it, and all of a sudden now you become, from over here, now you have X number of shares of common stock that's votable and maybe worth an awful lot of money when you bought in at a low price. The convertibility is a really nice feature. So in conclusion, it's a hybrid security. It's got the traits of stocks, got the traits of bonds. Okay, it could be a reliable source of income and a chance for growth, especially on the convertibility. If you're looking for that reliability, okay, it's critical, except for the fact, be careful, because a lot of preferred stock is issued by companies that have risky credit scores. But that could be part of your mad money, your 10% you may have in your portfolio set aside for that. But it really is often one of the more interesting features within any portfolio. Preferred stock investment, there's merit to it. Consider it, especially if you have a good, robust aspect of your portfolio and you want to have something unique and different in it, because of the fact it can play games between acting like a bond or acting like a stock. It might be a healthy addition to your portfolio as well. Take care.